Good afternoon, everyone. This is Tony Tatum along with my colleagues Shelby Gilbert, Nat DePina, and Nick Hill. We are all members of McGuireWoods insurance recovery practice, and we are very pleased to have you join us today to talk about some insurance issues related to the pandemic. Our practice at McGuireWoods is one where we represent policyholders only. It's across various industry spaces, one of which that we have a significant practice is in the healthcare, life sciences, private equity, energy, and financial institutions, and we focus on several lines of insurance coverage, two or three of which we'll be talking about today. So we thought we would start off of looking at where are we today, 16 months after the COVID pandemic, and really to take a look at this through the lens of the healthcare industry. As we all know, physician groups, hospitals, other providers have struggled with fewer elective procedures to drive revenue. The government's helped in some ways through the CARES Act, PPP loans, and there are obviously some other sources of funding out there, but there certainly has not been a one-size-fits-all silver bullet solution. And as we've seen in the papers and daily news coverage, healthcare providers are uniquely situated, given that they've got employees right there on the front line who are exposed to patients with COVID. One issue that is not solely faced by healthcare providers is mandating vaccinations for their employees. This is obviously a significant issue and one that we're going to talk about potential liability exposures and insurance related to that. And through the midst of all this, even before the pandemic, we all were aware of the government, DOJ's, FCA investigations in Ketam matters. It was a banner year in 2020 where the DOJ reported over $2.3 billion in settlements and $1.8 billion of which was from claims against healthcare providers. There has been, with all these challenges still, or maybe in part because of these challenges, increased M&A activity for the healthcare industry in Q4 2020, and we have seen that that has continued into the first and second quarter of 2021. So where does what in the world does all this have to do with insurance? Today we're going to talk about several pandemic-related implications across a couple lines of coverage. We'll start out talking about kind of where the case law sits today on business interruption insurance coverage from the pandemic. We'll focus on some provider claims that have been paid and matters in which we're representing policyholders. What we're starting to see with increased pressure on employment practices liability policies in light of the frontline worker exposures for healthcare providers. Take a look for a few minutes at the D&O market, which is pretty much a hard market for regardless of industry space. As you all, I'm sure, if you're aware of your company's premium payments, you'll know that on average they've gone up by 20% for D&O in 2020. Again, with this silver lining that there does appear to be continued M&A activity despite all these implications from the pandemic, and so we'll talk about where rep and warranty insurance intersects with that as well. So let's kick off. Shelby, why don't you get us started off on business interruption coverage and kind of the lay of the land.
Well, thank you, Tony. This is Shelby Gilbert, another partner in the McGuireWoods insurance recovery practice, and thank everyone for dialing in today. I'm going to talk a little bit about where we are in the pursuit of business interruption insurance coverage for COVID-19 losses. We've been in the middle of this now for the last year and a half almost. We have a number of claims that we have actually in litigation where we've gotten some good results and some good early rulings from the courts, but I know that the mantra, at least in the press and from a lot of insurance brokers, is that these claims are not being paid. And while that by and large is true, and most of the cases are going the insurer's way, there are some tips that we've got today and some coverages that we think that healthcare providers in particular should be looking at to make sure that they're not leaving money on the table when they hear from their broker that these claims just aren't covered, because that just hasn't been our experience. Healthcare providers sometimes have specific policies that will provide coverage for pandemic-related losses, and the last thing you want to do is to leave that money on the table. And the other thing that I'd note is, while people say that the hospitals are busier than ever, that the hospital beds are full, I think as any of you who have been in touch with your CFO and the finance team know, that may be true, but the more lucrative elective procedures and other outpatient procedures were not ongoing, particularly in the early stages of the pandemic. Many businesses had to stop serving those types of customers, and those revenues probably will never come back. So for a lot of providers out there, the pandemic did blow a significant hole in their revenues last year. And the good news, though, is that there is some insurance coverage. So we'll go to the next slide here. And I think when we're talking about business interruption coverage, I know a lot of folks have focused on this, but I thought maybe we'd step back and talk about how you get the business interruption coverage. Most providers have property insurance policies, and most commercial property policies contain at least some form of business interruption coverage. Typically, that's called either the time element coverage, the business income coverage, or business interruption. It varies from policy to policy. But the idea is that if you can first prove that you have what under the policy is called a physical loss of or damage to your property, and we'll go back to that term in a minute, but if you can meet that first showing and show that because you've had some sort of physical loss or damage to your property, your business has been interrupted, you have insurance coverage for that. So that's the business interruption component. That's the tie-in to the property damage policies. Other providers, many businesses have what's called contingent business interruption coverage, and this is typically meant to preserve your revenue streams if you can't get certain supplies from a specified customer, and as a result, that interferes with your business. And that's less important for healthcare providers, but we have looked at that for a couple clients, and is meaningful coverage to look at. So if your business has been interrupted because you can't get certain supplies during the pandemic from key suppliers to perform certain types of procedures, for example, that may be an avenue for coverage. Another coverage that we've looked at, been less successful so far, but at the outset of the pandemic, we were optimistic this would be a good avenue, was the civil authority coverage. There are lots of provisions in property damage policies that say that if there's an order of the government that essentially says that restricts access to your property and you lose business as a result of that, then there is business interruption coverage there as well. Now, the problem there is that the government order in most insurance policies has to be because there was actual or suspected property damage at your property. And the argument that the carriers are making, and have been successful in a lot of cases in the courts, is that, well, if you can't show that there's been physical loss or damage and you're just pointing to that government order without pointing to something that happened at your property, there's no coverage. We've got some ideas on how to deal with that argument, but that's another type of business interruption coverage. There's ingress-egress coverage. I think that's been less successful, but that's meant if something's blocking access to your property and you can't get in there to serve your customers, then there's business interruption coverage. And then the last thing that I think some providers have been not as focused on, but I think is important here, is extra expense coverage, which is meant to help reimburse you if you have extra expenses just so you can stay in business during the pandemic and you can establish coverage. Then for all those extra masks and cleaning supplies and decontamination and air purification systems that you've been buying, there may be coverage for that, and that, as long as that reduces your business interruption coverage. But I think the headline here is that the insurers are winning most of the cases, but we'll get into ways that policyholders may be more successful and have been more successful. So if we could go to the next slide, I think before we jump into that, more good news for healthcare providers that we ought to mention is that some providers actually have express coverage for communicable disease business interruption losses in their insurance policies. And on this slide, we've excerpted a policy that's fairly common. This coverage is found in a lot of the coverages provided by FM Global, provided by Zurich, and other leading insurers. And we've, as you can see on this slide, the coverage can be triggered as long as the policyholder can show that there's the actual or suspected presence of a communicable disease on the property. And then if you look at 3B, a decision of an officer of the insured to close the property that interrupts the business. And I think that most healthcare providers can actually show this because healthcare providers know how many patients they've had on site who have had COVID. They have been tracking employee cases, and they can make this showing that the COVID-19 virus actually was present at their facilities, and they can also point to decisions by senior management to close certain parts of a hospital or to close elective procedures. So this is a coverage that we think providers can establish. We've been successful at doing this for some of our clients, and I think the reaction from a lot of our clients initially has been, well, our broker told us there's no coverage in the policy. Well, we've found this coverage, which many providers actually have, and it's in the policy. And as you can see on the next slide, I think that the caveat here is that this is often subject to a sublimit, so you may have this coverage. It doesn't mean you're going to get the full $50, $100 million limit of your policy, but we have seen this coverage with limits of up to $5 and in some cases $10 million. And we've gotten, and we actually helped several of our clients monetize that coverage. Sometimes they just got a denial letter. Sometimes the insurance company just refused to adjust the claim or failed to even mention that aspect of the policy in their initial coverage letter. We wrote back and we were able to get coverage here. One issue here that sometimes happens, though, is you may be thinking, well, okay, well, I've got this coverage. I want to monetize it, but I also want to get all the business interruption coverage that we're entitled to. And one thing that we've seen from some insurers is that they may say, okay, we do offer you this coverage. You got us, we'll pay the $5 million that we owe, but everything else is excluded. And a number of insurers have been pursuing that strategy, including FM Global and Zurich and several others. And there are ways that you can address that. We don't think that just because you have this sublimated coverage means that you can't get coverage under other sections of the policy. We'd also note that if you actually pursued this coverage and it's been denied initially, and some of our healthcare clients pursued this coverage, then they got a denial, I think that the insurance industry has been taking a slightly inconsistent position, even within certain carrier groups, as to whether this coverage is applied and how much the insurance or how much the policyholder must show to document the actual or suspected presence of COVID-19 on their properties. But because the insurers are taking inconsistent positions on this issue, it's been easier in some cases, once you point that out, to get this coverage paid. So I'd encourage anyone who's on the call today to take a look at their policy, see if you've got this, if you haven't pursued it, because there are real dollars here. Now, a couple other reasons that I think healthcare providers may have stronger business interruption claims, and a lot of the press is about claims that have been brought by restaurants or hotels or all sorts of businesses pursuing these coverages. Because healthcare providers are on the front lines, they're treating patients, many of whom have COVID-19, have been on their property, it's much easier for a healthcare provider to show and make the threshold showing that the virus, at least, has been on their property, which is something that many businesses are not as well positioned to establish. Another note that I'd make is that many healthcare providers have property policies that don't contain virus exclusions, and we'll talk about what virus exclusions really look like and arguments you can make if you have something that an insurance company calls a virus exclusion, but it really isn't. I think that's where most providers are. You just don't have the broad virus exclusion that was promulgated by the insurance industry after the SARS epidemic of 2003. So that makes it easier sometimes to pursue coverage if you're a healthcare provider. And like I mentioned, I think a lot of providers have these communicable disease coverages as well. So what are some of the common issues that you need to look at if you're pursuing one of these claims? We'll talk about all four of these issues, but I think that the first one is just, and this is probably the gatekeeping issue for most policyholders, can you show that there's physical loss or damage to your property such that you can get into some of these coverages. I don't think that you have to show physical loss or damage for communicable disease coverage typically, but for the other coverages you do. And we'll talk about how some policyholders have been successful. One issue that comes up is, well, what happens if part of my business is open and part of it isn't? Can I still pursue business interruption coverage? I think the answer there is yes. I think you also need to look at the effect of government shutdown orders. Those have varied across the country and has resulted in some case law that's been diverging in different directions depending on what court you're in. And then we'll talk about the virus exclusion issue and how some policies that providers have really aren't virus exclusions. They're pollution exclusions that really, I don't think, should bar coverage for these types of lawsuits, and is one reason that providers often have better claims. So we'll talk first about the physical loss or damage issue, and as I mentioned, to get into the time element or business interruption coverage, you've got to show, typically, and 99% of all policies that are out there, that there has been physical loss or damage to the property. Those words, or some variation of those words, appears in virtually every commercial property policy in the United States. And right now, at least, courts around the country have reached varying conclusions as to whether COVID-19 losses constitute physical loss or damage. And sometimes that really breaks down on whether the policyholder and their complaint actually allege that COVID-19 was on their property. One reason for many of the dismissals of cases around the country is that a lot of plaintiffs' lawyers were taking cases that maybe they shouldn't have, that had broad virus exclusions in them. So they saw, well, the policy's got a virus exclusion in it, and I don't want to plead the virus is on the property because the claim would be excluded, so they tried to go in for the civil authority coverage and expressly pleaded in their complaint that there was no COVID-19 on the property, that there was no actual presence of the virus. Well, that made it fairly easy for a lot of federal courts around the country to dismiss those cases. Courts that have not, or plaintiffs that have not alleged their complaints in that way have sometimes been more successful. Now, another issue that is coming up frequently, and you may see this in a denial letter if you have one, or a reservation of rights letter, is that insurance companies often say, well, the physical loss or damage requirement means that you have to have structural damage to get into the business interruption coverage. So you got to have a tree fall on your property. You've got to have a fire or a flood. And if you don't have that, can't show structural damage to your property, there's no coverage. But this ignores the fact that, first of all, the insuring agreement of these policies certainly does not use the word structural damage or impose a structural damage requirement. And the words loss and damage, which both appear in the insuring agreement, mean different things. So damage might mean structural damage and loss means something else. And I think that many policyholders that have been successful in these cases have pointed to that disjunctive or as one way to get into the business interruption coverage. And I think that another argument that insurers have been making is that, well, COVID-19 harms people. It doesn't harm property. And there was an opinion from Judge Fitzwater in the Northern District of Texas earlier this week where that was the decision that he made, and as a result, COVID-19 can't cause physical loss or damage because it only harms people. Well, I think that ignores a long history of case law in other jurisdictions outside Texas and elsewhere that have held that invisible substances that may not actually cause structural damage can create physical loss of property such that you get into the business interruption coverage. So you think about smoke damage that can occur to a property, or gases that may be emitted from an adjoining property that prevent a policyholder from using their property. There's a long list of cases going back several decades that have found that those types of invisible substances, very similar to a virus, can cause physical loss or damage. So there are good arguments that can be made. Now, the government shutdown orders, which are relevant in part to the civil authority coverage, I think that this coverage has been tougher sledding for policyholders, and I think part of that is because the policyholders who really pursued the civil authority coverage did not plead in their complaints, as I mentioned earlier, that they actually had physical loss or damage on their properties. I think that this is something that we're looking at, and there are some courts that have found otherwise, that there is civil authority coverage for a shutdown order alone. But at least in what we're seeing in the landscape across the country is that the policyholders who at least are pleading that there is physical loss or damage are having more success in getting coverage tied to the government shutdown orders. Now, one strategy that the insurance industry is pursuing here is saying, okay, well, which is the proximate cause of the loss here? Is it the government shutdown order, which we think is excluded, or is it the virus or the pandemic? And there's an influential ruling out of the Northern District of Illinois that says, well, when you get into proximate cause issues, that's really a question for the jury. So that's not a decision or an issue that's really amenable to knocking a case out on a motion to dismiss or on summary judgment. If that's where the insurers are going with their argument, that's something that'll have to be decided at a later stage in the case. So I think the jury's still out on how the government shutdown orders will play, but in general, the civil authority section of the policy, when policyholders who have pled that alone have been less successful. Now, what about virus exclusions? I mentioned those, and I think that many of you may have a reservation of rights letter saying there's a virus exclusion in your policy. I think it's really important to look at the exclusion that the insurance company is actually citing or referring to in their letter. There was a very broad exclusion that was added to most commercial property policyholders, at least in the United States, to their policies around 2006. Many folks on the call may remember the SARS outbreak in 2003-2004 timeframe, and after that outbreak, there were some policyholders who, because they had to shut down their business during the SARS epidemic, pursued business interruption coverage. And in response to that, the insurance industry, through what's called the Insurance Services Office, which promulgates exclusions and policy forms for the industry, got their committees together, and they drafted this very broad exclusion that is on this particular slide. And they put that exclusion into the policies despite the argument that the industry is now making that a business interruption exclusion can never, or that there can never be business interruption coverage under a property damage policy. So query why they're adding this if they say, well, there's no coverage for pandemics or viruses to begin with. They added this exclusion. And I think in looking at all of our policyholder clients, probably 75% or more have some version of the ISO, what I call the ISO virus exclusion, but many do not. And I think that this is especially true for healthcare providers. I think that many have exclusions that actually are what's called a contaminant exclusion or a pollutant exclusion. And if you look at that exclusion, it really reads more like a pollution exclusion that's meant to exclude coverage for releases of contaminants or industrial pollutants. And though that exclusion may have the word virus in the exclusion along with a long list of other things that are excluded, it likely only relates to that fact pattern of industrial pollution. So we just don't think that if you juxtapose that exclusion in policies today with the ISO exclusion that's been out there and approved by regulators for the last 15 years, that the insurance industry can say with a straight face that the contaminant exclusion or a pollution exclusion actually bars coverage. And there's actually been an influential ruling on that case in the Thor Equities case in the Southern District of New York, where FM Global argued that a contaminant exclusion that used the word virus was sufficient to exclude coverage for COVID-19 losses. The court said, well, that exclusion is ambiguous. It doesn't accomplish that objective. If that's what they intended, we're going to need extrinsic evidence, or alternatively, it will be construed against the insurance company. Another thing that we see with these contaminant or pollution exclusions is that they only apply to cost often. They don't apply to loss. And those terms, so if you talk to your accounting team, those mean very different things. And the word cost and the word loss is often used very differently in insurance policies. So I think that if you have an exclusion that only applies to cost, the door is wide open to pursue coverage for loss. Many of these exclusions, too, lack the anti-concurrent causation language where words like, we won't pay for this unless if it directly, indirectly, howsoever relates to a virus. That language is absent typically from the contaminant and pollutant exclusions that many insurers are relying on. We've also seen some insurers rely on microorganism exclusions. Well, a virus is not a microorganism by most dictionary definitions. So lots of arguments if you don't have the standard ISO exclusion to say, well, these exclusions don't apply. And by the way, why are we even talking about virus exclusions? Doesn't that mean if you had to exclude it, doesn't that mean that there is physical loss or damage in the first place? Otherwise, you wouldn't have the need to add a virus exclusion to a policy. Now, another thing that you need to do if you're preparing a claim is you need to measure the loss, and many of our clients have pretty good finance teams already who can calculate the number of missed appointments, the missed outpatient procedures, and can do a year-over-year comparison. But depending on the size of the claim, sometimes we recommend retaining a forensic accountant to really document and determine what revenue your business lost year over year. I think that most providers are fairly good at this, but this is an important part of the claim, particularly if you can get outside of those communicable disease supplements and you're pursuing coverage under the entire policy. Extra expenses, we've talked about this. Most policies provide for this type of coverage as long as you can show that you incurred expenses for PPE, ventilation systems to reduce your overall business interruption. If you can establish coverage, those types of things should be covered. One issue that we've had to deal with for a number of our provider clients is that what do you do if we accepted some CARES Act money or if we had a PPP loan? Well, a PPP loan is a loan. You have to pay it back, and you can't count it as income unless you get forgiveness from the government. The CARES Act is really funding of last resort. You had the insurance policy beforehand, and if an insurance company can breach its obligations and then wait until there's a government bailout, I think that there's good case law that suggests the insurance company should be paying first. So we've had to counsel some of our clients on this. I mean, the goal obviously is not to double dip with your insurance policies and government funding, but there are ways that you can make these arguments to get maximum value out of our insurance policies. And a big part of that is the collateral source rule, and there's a lot of case law that says damages awarded to another plaintiff can't be reduced by other amounts paid to the plaintiff. Now, that rule is helpful, but there's also case law that's developed after other disasters where this exact type of argument has been rejected by courts around the country. So you look after Hurricane Katrina, and this was a case in California, the Northrop Grumman case against FM Global. Tax relief that was offered to companies after Hurricane Katrina was really an incentive to retain employees. It was not meant to compensate for the business interruption losses, so that couldn't be counted against the loss. And you think about, well, PPP loans, that's really meant to encourage you to keep your payroll going and to retain your employees. We think that this case law will be influential when this argument actually is litigated, if it is in these cases. The same goes for things like the FEMA payments. I think that this case with Hurricane Rita, the insurance company argued, well, you recovered FEMA money, so we don't have to pay as the insurance company. The courts have rejected that type of argument with respect to funds paid under the Stafford Act, and I think that will likely happen under the CARES Act as well. Now, in terms of trends that we're seeing in the case law and litigation scorecard so far, I think that it is a mixed bag. I think if you just look purely at the statistics, and I've got here some statistics from the University of Penn State Law School's got a good website that actually has data on all of the various motions to dismiss that have been filed around the country. And as you can see on these slides, the insurance companies are doing a much better job. They're winning more dismissals by and large, but I think that there are a couple distinctions here that are important. First, I think it's still very early. Only one of these decisions is by a federal appellate court so far. So I don't think that we really have guidance. It's probably going to be 3 or 4 years before the appellate courts have really weighed in on the physical loss or damage issue. I think another thing that we would note about these decisions is that most of the adverse decisions involve the policy with a broad virus exclusion. You can tell by looking at the data that if you don't have that ISO virus exclusion and you do a good job in your pleading, that you've got a much better chance of being successful. And I think that the other trend that we see is that policyholders who are pursuing their claims in state court have been much more successful. State court judges have been more amenable to these types of claims. Now, we'll note a couple of early policyholder victories. I note one here in the multi-district litigation where I'm co-lead plaintiff's counsel in a case against Society Insurance. We had a very influential ruling there in February where the court rejected the view, then denied the motion to dismiss, and adopted a very favorable standard that I think will actually require a fact finder to determine whether our clients in that case suffered direct physical loss. And the court also said that the policy language in that case, which did not involve a virus exclusion, that some of the policy language was ambiguous. And with those rulings, I think that decision has now been cited around the country and is helping turn the tide in some of these cases. I think this week there was another great case out of Pennsylvania State Court in Lackawanna County. I think that you think a state court ruling is not going to be influential. It's usually just a one-page denial. Well, this was a 61-page decision that went through in detail all of the cases around the country and explained why, based on the earlier line of authority I mentioned with other types of dangerous substances causing loss, why there should be coverage for COVID-19 cases. And there have been some cases even where in other state courts where courts have granted policyholder motions for summary judgment. And those cases are on appeal, but those are out there. And I think that some of those involve healthcare providers. Again, for some of the reasons I talked about earlier, they involve good orders for dental practices, optometrists, gynecologist practices. So I think that you need to be skeptical if you hear that the insurance company is always going to win these. That just hasn't been true. Now, in terms of appellate decisions, as I mentioned, there just have not been that many so far. There have been some federal courts that have certified questions to state Supreme Courts. And recently, the Eighth Circuit Court of Appeals issued the first appellate decision, and there they affirmed a dismissal of a district court in Iowa and said that there must be some sort of structural damage to property to get into the coverage. But I think there again, part of the problem with that ruling and with the insurance industry trying to rely on it is that the policyholder in that case did not plead the presence of COVID-19 at the premises. So the question that the Eighth Circuit was asked to address is different from the question that an appellate court might be asked to address if a trial court says that a healthcare provider can show that there was COVID-19 present on the property. So I think a few takeaways, and then we'll go on to our next topic, is that the COVID-19 business interruption landscape is very difficult for policyholders. I think that that's especially true in federal court. If you just look at the statistics, the insurance industry is winning more of these cases than they're losing. State court trend is different, but the policyholders who have alleged and can show the presence of COVID-19 at their premises and who have policies that don't have a virus exclusion, like the ISO exclusion, are doing a lot better in these cases. And I think that the decisions are going to continue to be mixed, and it's going to be a while before the landscape really settles out as appellate courts weigh in over the years. If you look at things like Hurricane Katrina, 9/11, disasters like that affected the national economy, it took, in some cases, 10 or 15 years before we really had a clear picture as to whether there were losses. So with all that said, we are encouraging all of our clients to err on the side of notice if you haven't noticed the claim, but more importantly, most of you have. So if you have noticed a claim but you haven't looked at your reservation of rights or denial letter, it might be a good idea to pick that up. Some policies do have suit limitations, so if you get a letter and you don't respond and you don't actually file suit within a particular time period, and we had a flurry of these in March at the outset of the pandemic, you may need to ask the insurance company to toll that suit provision. Most of them will do so. Or you may need to contemplate litigation. But that's the landscape on business interruption coverage, and I'd be happy to answer questions on this after the presentation, but we'll move on to our next topic.
Thank you, Shelby. This is Nat DePina, and Nick Hill and I are going to shift gears just a tad bit and talk about claims involving frontline workers. So although several companies remain closed, partially closed, or on a work-from-home status, some companies begun reopening since last year, which means we have a preview of the types of issues that reopening can present. Some employees may refuse to return in person for a variety of reasons, such as feeling unsafe, self-quarantining due to potential COVID-19 exposure, childcare issues, or even instances that they can continue doing their job effectively remotely. Some employees who have refused to return to the office for these exact reasons have been terminated and thus have filed wrongful termination lawsuits against their employers. In light of these lawsuits, many employers are curious about their policies relating to vaccines, as the safety benefits of vaccines are part of the reason employers are even reopening offices. But some employees don't want to get vaccinated. For instance, earlier this year, a detention officer in New Mexico sued officials who issued a vaccine requirement that he claims violates federal law. Some employment lawyers also speculate that before returning to the office, could face racial, political, or religious discrimination lawsuits. Such claims could include allegations that mandating vaccines creates heavier burdens on some employees than others, as not all people have equal access to vaccine facilities. Hopefully, access to the vaccine facilities will continue to become increasingly widespread, so this is less of an issue going forward. Workplace safety remains at the forefront of many people's minds. Employees may bring claims that they face hostile work environments if employees believe that their employers failed to implement adequate protective measures. Putting measures in place to create a safe work environment mitigates multiple risks. Then, because not only does it decrease the likelihood of hostile work environment claims, it also decreases the likelihood of claims that employees contracted COVID-19 due to workplace exposure. Even as case counts decrease and an increased percentage of the workforce has been vaccinated, it remains important to safeguard private medical information of employees. Unlawfully disclosing an employee's personal health information, such as COVID-19 results, could lead to allegations by employees that the employer committed a privacy right violation. Healthcare companies especially are used to safeguarding patient information under HIPAA and other privacy laws, so it is very important to be diligent to protect private information of these employees. Many of us are looking forward to increased social opportunities that office reopening may offer, such as happy hours and summer parties. But holding social events that involve socializing with members of the opposite sex could lead to more harassment claims that may have been less prevalent while people worked from home. So it may be a good idea to offer perhaps a refresher on workplace rules before planning social events this summer. It is also worth mentioning that as flexible workplace arrangements remain common, employers will likely continue to face wage and hour claims by employees who allege that their employers failed to pay overtime or off-the-clock work. Nick?
So Nat just discussed some of the claims that companies may face, and the good news is that employers' practice liability insurance, which is often abbreviated as EPLI or EPL, should provide coverage for many of these types of potential claims that Nat just described. For example, employment-related claims that fall under the EPL umbrella include claims like wrongful termination, employment discrimination, invasion of privacy, and workplace harassment. Therefore, EPL's importance in the return-to-work context is clear. When employees file the types of claims that Nat just described, it's important to provide notice of these claims to your EPL insurer. While employers may also be concerned about wage and hour type claims, particularly when a portion of your workforce is still working from home or working under a hybrid model, many EPL policies may contain a wage and hour exclusion that bar coverage for some of these claims. However, some policies may include a specific wage and hour coverage endorsement, so it's important to read your policy carefully to understand the scope of wage and hour coverage that your policy includes. Separate from the employment-related claims, Nat mentioned that there could be claims for employees who contract COVID-19 at the workplace. For claims like that, workers' compensation coverage may be available for employees and employers, especially in the healthcare industry, where workers have been working on the front lines and dealing with patients who are COVID-19 positive. Employees in other industries may struggle to demonstrate that they contracted COVID-19 at the workplace and that COVID-19 was a workplace-related illness. However, healthcare workers can more convincingly explain how, for them, COVID-19 is an occupational disease that is entitled to workers' compensation coverage. Now, we touched on it earlier, but Nat, for many employers, including healthcare providers who have many employees who interact with patients, these employers are thinking about issues related to vaccines in the workplace. What are some of these issues that healthcare providers are facing?
So healthcare companies nationwide are carefully considering whether a vaccine mandate is even a good idea. This continues to be a dilemma because, as of today, the FDA hasn't yet approved the vaccines. Using the mandate of flu shots, for example, however, is likely that it will become easier for companies to similarly require vaccines once they are stamped with the FDA approval. For now, it remains that vaccinations have become an important issue for healthcare providers as employees refuse to be vaccinated, citing the reasons that I explained a little earlier. For example, a recent study found that less than 50% of nurses have been vaccinated, which is a whopping number, given that nurses are frontline workers. An attempt to tackle this issue and increase its percentages of vaccinated employees, for example, a hospital in Houston, Texas decided to mandate vaccines. As anticipated, many refused to comply, and this resulted in more than 150 lost jobs. Over 100 terminated employees have since filed a lawsuit challenging the mandate, and then hundreds of protesters on either side congregate outside hospitals with the system. It is important to note that even when in place under federal law, vaccine mandates may be subject to exemptions based on disability or religious objection. Because vaccine manufacturers will likely have immunity and the government is unlikely to intervene, if an employee gets sick or dies from a vaccine that the employer mandated, they are likely to pursue liability against the employer. Now, having said all this, the fact remains that an employer is not simply subjected to liability just because a disgruntled employee brings forth a claim. For the reasons Shelby explained, a strong insurance coverage can help mitigate the risks employers face from employment claims.
So for lawsuits challenging the vaccine mandate as an employment policy, that's likely going to fall within the scope of the EPL coverage that we discussed earlier. The more unique claims from a coverage perspective would be where an employee who is vaccinated at the request of his or her employer experiences side effects, injury, or death, and then brings a claim against the employer. Workers' compensation insurance may provide coverage, but unlike contracting COVID-19 on the job site within the scope of the employee's normal job duties, a workers' compensation insurer may argue that an adverse side effect to a vaccine is not unique to employment in a way that triggers workers' comp coverage. In this case, employers should look to the employer's liability insurance coverage section of their workers' comp policy, which is often packaged as part of their workers' comp policy and therefore sometimes called, quote, Part 2 coverage relative to actual workers' comp coverage being Part 1. It provides coverage for certain injuries or illnesses to employers that are not covered by your standard workers' comp insurance. Therefore, this coverage section could provide coverage for allegations that an employer was negligent or grossly negligent or breached a duty to its employees by mandating that its employees get vaccinated. Finally, healthcare providers may be concerned about claims patients bring related to the actual treatment of these patients. The company's professional services liability insurance, or traditional medical malpractice insurance, would likely be the first line of defense for these claims. I'm going to turn it over now to Tony Tatum to discuss some D&O issues that healthcare providers may be facing.
So we talked about earlier in the introduction about the hard market and just, how painful has the hardening market really been? I'd say on a scale of 1 to 10, most of you would say pretty close to a 10, right? There's been 14 consecutive quarters of increasing premiums in the cyber and D&O insurance space, a whopping 35% in Q1 2021 for cyber, and similar increased numbers for D&O. And as you've probably heard from your broker, the healthcare space is particularly prone to increases. They were before. The cyber market was tough because of the information that healthcare providers store, and the pandemic has only exacerbated the issues on a premium standpoint. Now, looking at the terms for just a minute in both D&O and cyber policies, what we're seeing is insurers often trying to take what is very broad private entity coverage and really reducing it to securities claim coverage, which of course is not going to be that meaningful for a non-public company. We're also seeing, in addition to higher premiums, higher SIRs and deductibles, more expressly stated False Claims Act exclusions or sublimits, although insurers know that they face tremendous competitive pressure if they have an express FCA exclusion. Merger-related exclusions creeping in. What we call the four exclusions, like four bodily injuries, are going back to some arising out of preamble language. So it's important now, as much as ever, to be carefully looking at your policies with your broker and coverage counsel when you go into renewal. On the cyber side, one of the key things we're seeing is a narrowing of coverage for ransomware losses. And we know, 2 months ago with the Colonial Pipeline attack, which was highly publicized, there are scores of those that we don't hear about. There's tightening of business interruption coverage. We're seeing some terms that were defined in a way that would give real meaning, like cyber terrorism, that they're not being defined anymore. And that just leads to ambiguity, potential ambiguity anyway, and uncertainty for you when you have a claim. Notice provisions are becoming stricter, including for giving notice immediately for circumstances that could lead to a claim. And just on the topic of cyber coverage in general, you all know that there should be coverage for D&O claims that have, cyber breach claims of wrongful acts related to it against directors and officers, but we're seeing cyber exclusions pop up in D&O policies. So again, be very attuned to looking at your policies when you're going to renew them. Now, we've talked a good bit, Shelby did, about the CARES Act and PPP loans. The scrutiny is there, and just a beating for healthcare providers who are already subject to scrutiny under the FCA before the pandemic. Now, healthcare providers, and of course other companies and individuals too, are potentially subject to FCA investigations and QTAM lawsuits for alleged receipt of PP loans and using those funds fraudulently. There's been a number of individuals who have been charged. I think it's something like 500 for fraud and PPP loans, and the DOJ is indicating that it really is just revving up the engines on that front. And if you've ever had an FCA investigation, you know that the act itself has got significant teeth. In addition to civil remedies, the DOJ can seek treble damages and significant civil penalties of up to $23,000 per violation and attorney's fees. So this can be something akin to bet the company exposure if you have one. Haven't been a whole lot of settlements for PPA, FCA investigations yet. I think there's been at least one published one for a California-based internet retailer, but we expect more of those are certainly in the mix and being discussed, and we'll hear more about settlements over the coming months. Now, where are you going to get coverage for PPA PPP wrongful act claims, well, likely under your D&O policy. As we noted before, the policy in most private company policies provides broad coverage for claims alleging wrongful acts, and wrongful acts can be actual or alleged wrongful acts. As I noted earlier in the introduction, a number of insurers are starting to add what I'll call a specific or express False Claims Act exclusion. Until recently, there have been a handful of those, and insurers have sold those policies and then tried to rely on other provisions that weren't intended to exclude FCA defense costs and settlements. But now, with just the proliferation of FCA investigations and claims, we're seeing, the words False Claims Act being added. While there are several provisions of D&O policies that are common, kind of regardless of the insurer, setting aside an express exclusion for False Claims Act, you really do have to carefully review the policy, the D&O policy, to see whether or not there may be coverage for an FCA claim, because loss definitions certainly vary quite a bit, and that's a core place that you go to look to see whether or not there'll be coverage for FCA claims. A couple key takeaways here on coverage considerations for FCA claims before we close out with updating on M&A activity and rep and warranty policies. The first two are inextricably intertwined. That's notice and claim accrual. We all know that you're in a dilemma when you have a key TAM that's filed under seal and you don't have a partial lifting, and the dilemma of, do I give notice or not? That, of course, in part depends on what and how the policy defines Cap C claim, and whether or not you have to give notice of a complaint or after service of a complaint. So these are all seemingly perhaps not significant terms or words like service, but they can be quite important when you actually have a claim. So those two provisions in particular warrant scrutiny with your broker and coverage counsel. And of course, as we just briefly noted on loss, really focusing on that definition to make sure that it is not overbroad and exclude things that you would typically expect to be covered for FCA claims or D&O claims. Nick?
So we've made it to the home stretch. We're on the last section to discuss healthcare M&A in the world of COVID-19. The healthcare space had a busy year of M&A 2 years ago in 2019, but then for obvious reasons, healthcare M&A declined in 2020, both due to deals getting put on hold at the start of the pandemic due to the economic uncertainty, as well as due to many healthcare providers needing to focus all attention on serving at the front lines of the pandemic response. As the economy and financial markets bounced back and stabilized last year, healthcare services companies reached record deal volumes by the fourth quarter of 2020 and in the first quarter of 2021. Healthcare and hospital system M&A is expected to increase through the course of this year, too. Over the past several years, buyers in transactions, especially in the private equity market, have increasingly used reps and warranties insurance, or RWI, to protect against potential seller breaches. Under reps and warranties insurance, the buyer can recover directly from the RWI insurer rather than from the seller for certain breaches of the seller's representations and warranties in the acquisition agreement. This insurance product therefore shifts the risk of certain losses from the seller to an insurer, which can reduce, or in some instances even eliminate, the need for a seller's escrow or indemnity basket for certain types of claims. While RWI insurers have policy forms, RWI policies tend to be less standardized than some other lines of coverage. In particular, the exclusions in RWI policies are often heavily negotiated and subject to change during the diligence phase of the transaction and related insurance underwriting. When COVID-19 first became a major force in early 2020, Many deals that were proceeding with reps and warranties insurance at that time saw their RWI insurers insist on including broad COVID-19 exclusions due to the unknown effects the pandemic would have on different industries. Over the course of 2020 and into 2021, some RWI insurers began agreeing to narrow COVID-19 exclusions based on information gathered during the diligence period to better tailor the exclusions to the specifics of the transaction at issue. I've also seen RWI insurers agree to add causal links to a COVID-19 exclusion so that instead of excluding any and all losses arising from or connected to COVID-19, the RWI insurer may agree to exclude only losses, quote, directly or, quote, proximately arising from COVID-19. The successful negotiation of these exclusions requires a team effort among the Healthcare Providers Insurance Council, the insurance broker, the M&A council, issue specialists, and deal team members to explain to the RWI insurer why it should agree to remove or narrow a COVID-19 exclusion. For M&A activity among healthcare providers where the target received PPP loans or other CARES Act or government funds related to the pandemic, nearly all RWI insurers will insist on a PPP or CARES Act exclusion so that, for instance, it does not have to cover as an insured loss a claim that a PPP loan was not forgiven. Insurers have been resistant to removing these exclusions, but as with the COVID-19 pandemic, and reps and warranties insurance specifically, it is still a fluid and ever-changing product, so have your team ready to negotiate best-in-class terms on your next deal. That wraps it up for our presentation portion today, but Shelby and Nat and I are on the line if anyone has any questions or comments, and we certainly want to thank everyone for joining us today.
And if anyone has any questions, they can use the chat box to ask any questions you want and try to answer them. Give a couple minutes for that. And Nick, while we're looking for that, do you anticipate that the rep and warranty insurers, that there will be more competition between them in terms of terms and conditions and COVID exclusions in the months ahead as we get farther and farther away from the early days of the pandemic?
I think there will be. As the economy has done well and M&A activity has picked up, the need for using reps and warranties insurance has also picked up. There are a lot of insurers in the space who are competing for these deals, and part of the competition for these deals will be when insurers are quoting their proposals for them to offer to either not use or narrow COVID exclusions, because that can certainly be a differentiating factor for a company choosing which insurer to go with on a reps and warranties policy.
And it looks like there is a question in the chat box. Someone has asked, is there a summary of the cases in the COVID-19 business interruption area that shows which of the insurers have been more successful in obtaining dismissals? And I think that there is some data on the Penn State Law website that I mentioned earlier today, and I'd be happy to follow up with anyone offline if they've got questions about our experience. But what we have seen is that the insurers who do not have virus exclusions in their form policies or their base policy, they've been the least successful and have been the ones that have been targeted the most. So you look at insurers like Cincinnati Insurance and Society Insurance and a number of others, State Auto and the like, that did not have the broad exclusion. They've had the toughest go. I think that there are others that it's kind of really hard to generalize. It just depends on what state and what jurisdiction they're in. But there is some data on that, and I'd encourage you to look at that Penn State website. Well, I think that that's all the questions we have. I'd like to thank everyone for joining. And again, if any questions or comments, I think you've got our contact information in the materials. We'd be happy to follow up with you after the presentation if there's any further questions. Thank you very much.